I think it's time to get this show on the road. Well, good morning, everyone. My name's Michael Bedwell. I'm the head of NAB's education team. And thank you for sharing some time with us this morning for this session. It's prepared specifically for our clients in the university sector. I'd like to begin by acknowledging the traditional owners of the various lands from which we are dialing in from today and pay my respects to elders past, present and emerging. It's my pleasure to welcome you here to hear from Ivan and John, and just a reminder that this session is being recorded. The reason we run this session at this time each year is our attempt to help arm you with some statistics, a few great charts, and some sound bites for your finance council meetings, your budget planning, and all the preparations we know that you're in the middle of as we rapidly approach the new academic year. I'd like to acknowledge the terrific response to this morning's call with the unis and specialist education providers from all corners of the country. And for the first time, we welcome some of your investors, both domestic and offshore, to this morning's call. So 2021 in many ways has been a weird old year, and we hope, we'd hoped that this time last year we'd be returning to some sort of normal, and instead we've spent most of the year in fear, or if you're in Melbourne or Sydney, actually in lockdown for the majority of the year. And be remembered by me as the year of the vaccination, as shown by Ivan's background that you'll see very shortly. As NAB is proudly the leading supporter to the university sector, we've observed a year of consolidation and preparation, getting ready for the return of students, both domestic and international, for 2022, hopefully, and beyond. We've seen this in a number of ways. It's played out across a number of different aspects. We've seen the continuation of the cash buildup across the sector, the continuation of that tightened capex and deferred spending, restructuring activities have sort of continued to play out through the course of the year. And we find ourselves here today with a little bit of hope around the recovery plans, which will be put into action in the coming years. Certainly remains a fluid political environment, and the messages that we get from all levels of government are pretty hard to read. Might benefit from some Squid Game style subtitles so that we can understand what the underlying message really is sometimes. From the changing stance we've seen around the sector, the recent acknowledgement of how important international students as well as other international contributors to our economy are. And more recently, there's been even changes from APRA that we expect will impact the sector starting in January 2023. But enough from me. We've got two presenters today. We've got a presentation from Ivan and one from John, followed by a short panel with a Q&A session to be hosted by Fiona. But starting us off today will be Ivan Colquhoun, one of Australia's most famous Tasmanians. And unlike Tim Payne, Ivan's retained his captaincy position as NAB's Chief Economist Markets. And we're pleased to have Ivan talk us through his presentation today. Over to you, Ivan.
Thanks, Betters. And just a quick piece of advertising. My background, just to note that NAB Trade, or JAB Trade as we're currently calling NAB Trade, is donating all its commissions from today to charity. 80% is going to facilitate vaccinations in less fortunate parts of the world than Australia. So encourage people, if you are thinking of doing a trade, think about NAB Trade. Okay, on to the presentation. And it was very good of Betters to organise for Scott Morrison to reopen the international borders from the 1st of December for student business, and announced that yesterday in time for our presentation today. So that's, I think, fantastic news. So it really will allow a few months to get organised, and obviously there'll be a lot of interest to see how those visa applications come through. But I think really a very positive development as a backdrop to this presentation. I thought I'd just give you a framework to think about things. Starting off with what are the questions people are asking us at the moment, and all the questions are basically about difficulties getting skilled labour, wages pressures, inflationary pressures, and interest rates. Those are the highlights at the moment. There's some questions about once borders reopen, how quickly will those international activities, the migration, the tourism, international students rebuild? There's the whole question about Evergrande, which is having an impact on the Chinese economy. And that's pretty important because, like tourism, the biggest determinant of foreign tourists and foreign students is typically GDP in the home country rather than the currency. The currency is a secondary factor. There's a whole question about how will the economy rebound from the latest lockdowns. And I think also it very much depends on what industry you're in. What's your post-COVID level of activity going to look like? Is there pent-up demand? I think there could be for education. Has demand been pulled forward? I think in goods it may be. And some demand will simply be destroyed and some things might be permanently different. So those are some of the key questions. I think the way I like to think about the economy, and we got a presentation once from some weather forecasters, and you probably all heard the joke about weather forecasters and economists, and the punchline's a bit different depending on who's telling the joke. But the thing I took away was they really said, think about the big forces that are affecting the outlook when you're forecasting. So there were a couple of things that are pretty important before COVID even struck. Australia had this slow wages growth, we had a housing downturn and a drought, and we had very low interest rates around the world, which were gradually filtering into our economy. We had, as you know, very strong immigration, a very tight fiscal policy, and then we had some continuing, structural changes, shift to online retail, perhaps we could say shift to online learning as well, or that was emerging. So they were all there. Have they been changed by COVID? Have they been accelerated? I think is an important question. And then obviously the last 2 years, the biggest forces are the spread of the virus and what that has brought about, and then the policy response. So when COVID is spreading rapidly, you get lockdowns. As we know, we got border closures, and that's had a massive impact on your sector. And then we've also had quite a big switch in spending from services to goods. Now, that is probably more relevant for a lot of other sectors, but it's part of the supply chain disruptions that we're seeing at the moment. It's part of the price pressures in various sectors as well. And then we got these other government support, but I think the most important policy support has actually been the health policy, because this has been a health crisis and it largely needs a health solution. It's had all these other parts of policy assist with the shock, but really the permanent solution is related to health. So when we think about the outlook, I think really it is the rollout of vaccines. Boosters are going to be very important. We've begun to see interest rates normalise around the world. This reopening of the borders is critical. And I think also the question on inflation is a lot to do with how much spending switches back to services. So really quickly on the virus, Australia is doing really well. Still, the outbreaks in Victoria, New South Wales, ACT, on the territory, they're on a global scale, they're still very, very small. And perhaps that could be a marketing positive for Australia and Australian universities, because we're seeing much bigger outbreaks again in Europe, and we're seeing the US having, more, higher levels of COVID. I guess the alternative argument to that, of course, is that it's not really affecting people below the ages of 25 very much if they're fit and healthy. But again, it could be a marketing story. Australia has got some very, very good numbers. Look at this, over 16, 91.5%. So we're a very highly vaccinated country. That's of 16 plus. And we're now rolling it out to 12 to 15s and 5 to 12s, I think will be next year as well. And we've really blown past these first phases of the government's reopening plan. This was 70%, this was 80%. The final phase, which includes opening international borders, which has been so important for your industry, was beyond 80%, and we're well beyond 80%. Now, it's not uniform across the country. There's a few, sorry, I've missed a slide there. It's a little bit lagging in Western Australia and Queensland, Northern Territory, but it's not a big lag. It's 4 or 6 weeks. And obviously the West Australian government is reopening a little bit more slowly, but you can still get into the country. And with the international borders open, you can still look at quarantine. So I think everyone has the ability to get people back in. This is a summary. I won't go through it all, but to varying degrees, we are reopening, and that's really good news. And then, as I said, in Europe, this is a bit of a story at the moment. You can see this rise in infections. We delved into this in our latest weekly. What we're finding is that the rise is particularly in older age groups. It's in unvaccinated people, but it's also in fully vaccinated older people. And we think this is relating to the vaccine efficacy, which deteriorates across time. So you need to, governments need to roll out the booster. That's the way we keep the economies open. So that's very important. What about the general business climate? Well, before the recent lockdowns, it was very good. Businesses in the NAB business survey were saying record business conditions. You can see we've begun to recover there. And I think obviously it depends what sector you're in, and universities wouldn't be saying it's record business conditions. Neither would international airlines, but I think we can look for some better news over the next few months and next year. Job ads, which is another great indicator of the economy, record levels. Now, part of that reflects the closed borders, but I think also very importantly, job ads have bounced back quite strongly from these lockdowns. So if you were unfortunate enough to have lost your job, then you've got the ability to find another one. And that means that the economy can rebound reasonably quickly from this lockdown. This also is showing that the labour market is very, very tight at the moment. And for example, if you look at all states and territories, job ads are a lot higher than they were before the pandemic, mostly 50 to 70% higher, ACT lagging a bit. And if you look at education and training, I can't see exactly what that number is because I'm in the way, but it's 50% higher. So there's a lot of demand for labour. Hospitality, tourism, farming, a lot of those are overseas, filled by short-term foreign workers, which should hopefully recover. No guarantees when the borders open, but hopefully that will happen. And we delved into the SEEK ads for education and training. And apart from tertiary teaching, the job ads are still down. You can see that in other higher education types of activities, ads are higher than they were before the pandemic, which is perhaps a little bit of a surprise. And I suspect with that reopening announcement, they're going to go up in the next few months. So I think a key challenge, which lots of other sectors are experiencing, maybe comes through in the higher education sector as well in the next few months, where we want to reopen and there's not a lot of spare labour around at the moment. So wages pressures could be there. Again, this perhaps could be something to attract students with if there are some extra jobs on campus that foreign students could do, perhaps. The other good news, I think, out of this is when we see job ads really high, normally that means that the unemployment rate can drop. So I'm expecting that to bounce back pretty sharply in the next few months, which again is part of the Australian economy doing quite well. The other big question is about what will happen to inflation and wages. And you can see here that part of what's happened, no surprise here, is that net migration has collapsed. We're expecting it to pick back up. We're uncertain about how quickly that will happen, and we're going to be looking at these different data, and probably the university sector, you will know more about it earlier than we economists will. So if you want to drop me an email saying how much your enrolments are up, I'd love to hear that information. But I think we can expect that pretty quickly over the next few months. And I think if you look at enrolments, they were moving up a little bit before the latest lockdowns, which I think have really impacted the sector. But again, the next few months with that announcement information should be much better. I think the Q3 GDP numbers, which we'll get at the start of December, are basically irrelevant. We know that when you lock down, activity falls, and you hope that when you reopen, activity recovers, and all the indications I've seen are that will be the case. Other reasons for bouncing back, households have got a lot of money. And this was the other key theme, I think. You can see that spending on services much reduced through here, a lot of switch to spending on goods. And that, I think, is part of these higher inflationary pressures, supply chain disruptions. It's not just that people can't make the widgets. Demand for widgets has gone up an awful lot. And if you think about this shift, it's been done by pretty much 7 billion people around the globe at the same time. So there's a big demand story in the shift to spending on goods. So how does that feed into the outlook for interest rates? Well, the RBA is saying this third dot point, they're not going to increase the rate from 0.1 effectively until actual inflation is sustainably 2 to 3, and the latter requires wages above 3. So that's their reaction function. Now, so what are the markets saying? Well, the markets are saying we do not believe the Reserve Bank at all, because the Reserve Bank's been saying their central case is that they won't increase interest rates until 2024. But you can see here that yesterday, the market was predicting the cash rate would be 1.84% by November 23. So that's effectively 7 interest rate rises from where we are. So the market's got a very different picture. Why is that the case? I personally also think the Reserve Bank's losing its way a bit on policy. They haven't really forecast or analysed the economy very well during COVID, and particularly the bounce back. And we can see this in house prices. They've been bouncing very strongly. And I think that's because interest rates, not opposed to them being super low when COVID was there. I think, which we're seeing in some other central banks around the world, they're beginning to take away that emergency support. So the big question for interest rates and Reserve Bank is whether we're seeing a pickup in inflation at the moment. Is it going to be persistently higher? Is it going to reverse and go back to the previous trend? Or is it actually perhaps going to completely reverse and then pick up the previous trend? A good example of that, I think, is used car prices. No one's given me a good reason why used car prices will be permanently higher and inflate at a higher rate. So when we look at our surveys, we see that businesses are reporting input costs are much higher. They're reporting retail prices much higher. And before the lockdown here, they were reporting that labour costs were much higher. So that's all part of this COVID closed borders and that shift in demand to goods. Part of the shift in demand to goods, we've seen very high freight costs. So again, for some of the things that you might be ordering to restock, I think prices will be higher. The question is, will this be permanently higher or will prices come back? We think they'll be, we're calling it long transitory, but we think it will be transitory. We will see that shift back from demand for goods to services. And again, I'd say the RBA, I think they've been characterising inflation and wages much too low. This was their forecast in August for inflation. They said it would get back to 2.1 or 2.2% at the end of 2023, made in August. When the Q3 CPI came out, they were back where they thought they'd be in 2 and a bit years' time. So I think they've been characterising inflation and wages far too low. I'm going to skip through a few of these charts and just show you the currency. As I said, I think the currency is very much a secondary effect in the decision to educate overseas and the decision to travel overseas. It's very much about activity and growth and employment in the home economy. Our models have been saying the Aussie dollar should be worth a lot more than it is. It hasn't been. And what's been happening is actually the US dollar has been strengthening. Typically when the US dollar strengthens, the Aussie dollar comes down. So I think the Aussie dollar at the moment, the US dollar is strong, probably remains strong. So that should mean that at least against US dollar countries, we're probably holding up quite well. And then finally, I would just point that most of the China-Australia trade political dispute, be very interesting to see what happens with students and tourism. There were some good articles in the paper on Monday suggesting that Chinese students remain very engaged with Australia. And I think China has continued to buy lots and lots of iron ore, which is very important to its economy. And I think education, foreign educations will remain very important to Chinese as well. But I'm watching property quite closely. And the final thing I would say is just a little bit of, I call it advertising. So if you would like to receive some of our research, we'll send these slides around. You can click here to sign up for the research. I'm going to stop sharing there and I'll be back for a few questions shortly. So over to you, John.
Thanks, Ivan. I'm going to throw to John shortly. Great reminder there for everyone, though, that we do have the opportunity for Q&A after John's presentation. So please do feel free to use the Q&A function at the bottom of your screen there and send through any queries. I'll just do a very, very brief introduction to John. John Manning's well known to many of you on the call in his role at Moody's as Vice President and Senior Credit Officer. He's got responsibilities for ratings and research on regional and local governments and the associated issuers, which includes the universities in Australia. We're delighted to have John join us today, and it's great that he'll be able to share with us the Moody's view from both a global and a local perspective. So over to you, John.
Great. Well, thank you, Michael. And thank you also, NAB, for putting on today's event. Hopefully you can see my screen that I'm sharing for you. It was interesting. Recently, I sat down with a couple of university students who, for the past 2 years, their only 2 years at university, have been stuck in their bedroom looking at a screen. I wanted to understand from their perspective, what's the cost of a COVID impacted education? It's not just to providers, but also to the students. And then we started to talk about how easily international students could be reintroduced, potential implications for social distancing. And even though many universities are preparing to go back next year, the question's always going to be there for those larger courses, the 800,000 seat lecture theatre full in those first year type subjects. Are they going to have to be online? So all those sort of challenges are quite considerable. And then what does the on-campus future look like for a post-COVID education? Now that will differ by location and it will differ by faculty as well. But this morning I've been asked to provide some insight on how we see the recovery for higher education in Australia. And I agree with Ivan, broadly the underlying momentum in Australia Inc. is really, really robust, underpinned by good employment data, pent-up demand, savings rates still remain elevated, and that housing market has been very, very strong and assisted by a lot of policy from not just states, but also from the Commonwealth. But the biggest thing at the moment, I think, to keep an eye on is this vaccination-led recovery. And it is proving inconsistent or uneven across jurisdictions. So where's the best line of sight for the Australian higher education sector in 2022? I think the answer to that lies in the global context. Globally, the pandemic has been really challenging. The rapid response from the sector globally was very, very strong. We had that preserve liquidity, reduce costs, reassess underlying business and delivery models. And that's nothing to speak of the immense volatility that we saw in investment markets, which had over the December 2020 balance date period for the Australian sector had quite an impact on investment portfolios, but that has bounced back quite strongly too. So I just wanted to give an idea of from a global perspective, what's Moody's insights? What are we seeing? What similarities are evident? And importantly, I think it's key to highlight the underlying operating environment, because what we saw last year and throughout 2021 has been a significant and sometimes unintended role of the operating environment. So globally, Moody's covers close on 600 different universities and colleges that we have ratings for. And in Australia, we have 8 public ratings. And on this schematic here, what I've tried to highlight is really to depict the publicly rated Australian unis, but also tie them back to the operating environment, because that's really key. And because of border controls, which have only emerged in the past 2 years as a concept in Australia, the different jurisdictions in which universities operate are really important to understand. The Australian sector is a very highly rated sector. There's that very robust institutional framework with the Commonwealth and also with the states. That really does deliver a very stable and predictable funding model for the sector. And in contrast to, say, the Canadians or the US, Australia, we think, is more like the UK. It's a centralised model. And I'll get back to that later on to see where really we find the benefits of the centralised model that the Australian universities are. And this has really delivered quite a strong underlying operating environment for the Australian university sector over the past year and a half. And this is despite elevated trade tensions and ongoing geopolitical challenges. And there's one thing that I wanted to bring to everyone's attention is that at Moody's, we actually updated our methodology recently. This is not as a result of the pandemic. Just like universities, rating agencies tend to have a long lead time to adapt and to make sure that any changes are done appropriately. But really the key for us was the landscape for higher education changed significantly in the past decade. It's very much a fundamental shift that we see in the sector, and we needed to make sure that our methodology was appropriate and equally forward-looking. Yeah, and 18 months ago, we faced a significant revenue shock, significant levels of uncertainty from the pandemic. And this really underpinned, we were heading in the right direction with this new methodology because we've increased the qualitative factors. And that increased measure is really important when we're looking to get a detailed understanding of what the underlying environment is and the operating environment. So how did Moody's see the COVID impacted education? I think really quite simply, the Northern Hemisphere education year at the initial the initial COVID outbreak in early 2020, it really highlighted that Australia was the canary in the coal mine. I say that because a lot of it was just before the start of our education year, but a lot of our international cohort were enjoying Lunar New Year celebrations overseas at the time. This is in distinct contrast to the UK, Canada, and the US, which were midway through their second semester. So a lot of their students, international students, were still there. But as 2021 progressed, the impact of travel restrictions remained, successive lockdowns, and then the underlying unintended policy decisions really started to play through. And I've tried in this slide to highlight some consistencies that we've seen globally. Now, some of it's not going to be rocket science to you, of course. Border closures impacted international. But consistently, we've seen very strong domestic demand, not just in Australia, but globally. The capacity to reduce expenses in a sector that has traditionally been earmarked as one with a very fixed cost base, which is very hard to change, it was really quite impressive. And not just in Australia, but in the US, we actually saw record levels of staff reductions, furloughs, temporary suspensions, hiring freezes and layoffs. We actually saw around 600,000 higher education positions cut in the US last year, over the last 18 months. Now that is the highest level in history. So in the context of this, really the key, I think, is to focus and say, well, beyond these similarities, some major changes occurred, and these challenges were pretty significant in some operating environments. And I just wanted to just briefly highlight this slide to you, and I'm not going to read it. These slides will be available to everyone. But this is a really important observation that we've seen. It's funding models. And I've spoken a few times with the reference of operating environment. What we saw last year, for example, in Ontario, you've got to remember the Canadian sector is largely funded at the province level, not at the Commonwealth or the federal level. And this is where its elements have been decentralised. And similar in the US. We saw revenue pressure coming from the province. Revenue pressure, not just in the terms of the funding available, but interference. And the interference in the context of university pricing models is particularly unwelcome from a credit risk perspective. We also saw some government policies that came in and unintentionally had some broader impacts on credit profiles. We did change some of our extraordinary support assumptions globally as a result of the way that government policy was, how it played out through 2021. Australia, very different. It faced a revenue shock, and that Fortress Australia approach, it's proved relatively successful if we go on the operating performance of universities over the past 12 months. In the US, we had very restrictive immigration policies to the extent where if you were an international student, you couldn't stay in the US and study 100% online. You had to leave the country. So there's a lot of factors at play, but then some policy decisions had extremely positive results as well, particularly as far as linkages with visa requirements and in Canada and in Australia. The supportive position that provided, I think, is really, really key. But given that backdrop, how is Australia and not Australia Inc., but the Australian university sector, how are we positioned for 2022? And I think this is really interesting because, well, you probably have a better line of sight than I do for Australia. But what I can offer today's discussion is a little bit of context. We've only just started the 2022 education year in Canada, the UK, and the US. So there's a few areas there that I'd just like to try and bring out for your attention. And really, I think it's a turnaround. I think the canary in the coal mine at the moment is the Northern Hemisphere. And there are some observations that we will have that we can really get some good clarity on. Obviously, there's the compound impact of international students that may or may not be on campus. The balance sheets globally, they've come into this year in the Northern Hemisphere quite strong. Liquidity's been improved, and the investments, those wealth portfolios, they didn't see that typical recessionary style of impact that we would normally have anticipated through such a significant shock as the pandemic. But really, it's quite surprising when we look at enrolments. Canada, UK, they're okay. The US, it's down again. And particularly in community colleges. They're down quite significantly this year, whereas the larger, more selective institutions, those with the really strong brands, they've fared far better than the less selective ones. And increasingly, we're starting to see early signs of substitution risk, and that being quite elevated. But the other one that I wanted to highlight today is really when it gets to tuition discounting. It hasn't been a big play in Australia. We saw UQ do some subtle changes last year, but it hasn't been a real major issue. The integrity of the pricing model has been preserved. In Canada, some universities had outside interference on their pricing model, but in the US, this recent fall, what we've seen is a really significant uptick in tuition discounting. And that's playing through at quite large numbers. A 50% discount on your tuition fees, that's not uncommon at all. And sometimes you'll see even higher than that this year. And I think that's really important to just be mindful of, as there's elements of substitution risk, and preserving pricing models are really important for the Australian sector. And then I just wanted to finally just touch on a few high-level things that we're also seeing. And Ivan touched on this earlier as far as inflation, and it's proving a big challenge for the sector offshore. It's not just a matter of supply and price, but it goes down to the responses that the higher education in the Northern Hemisphere have played over the past 2 years. That real permanent cost out. It's not easy to get good academics back in this sector quickly. So making sure that the cuts have been done in the right place, but they haven't been overdone. That's a big challenge. And high quality labour in the university sector is not a quick fix to rebuild. And as I say, it's not just in academics. We're seeing increasingly those universities that have hospitals, they're seeing quite a playthrough as well. The healthcare sector globally is facing nursing shortages. But in Australia, we've seen it in the US, I think one of the key variables at the moment will be this concept of the great resignation, the unvaxxed great resignation that may or may not come through. What we're finding in the US is that universities with hospital facilities are being significantly impacted as far as scarcity of nursing staff. Whilst they've got their own graduates, a lot of those are being taken out fairly quickly in the piece. So there's some emerging challenges there. We are seeing a lot of supply chain and shipping disruption play through to the sector in the context of capital spend. We're seeing CapEx being just pushed further down. Temporarily, that's less of a draw on liquidity, which is not a negative aspect, but we are seeing, and Ivan had some good charts on this earlier, as far as the revenue pressures or the cost pressures that are flowing through to capital spend we see. But ultimately, vaccination is subject to jurisdictional politics in Australia. I don't think we can ignore that. The reopening of campuses in Australia, it's going to be interesting to see how the vaccination requirements are managed on campus. In the US, it's very, very different on a state-by-state basis. Some require full vaccinations, others, it's fairly free and easy. And we also have the added complication in Australia of border reopenings. And whilst international border reopenings are starting to play through early next month, particularly in New South Wales and Victoria, that uneven rate of state borders reopening and international borders in Australia will play through, we think, and be a big driver and highlight some jurisdictional differences in the Australian sector going into 2022, particularly when we're looking at on-campus learning. But at that, I think I'd like to say thank you. Thanks for your time, and I'll hand back to Michael, and we can take some Q&A. We'll move to the panel.
Thanks, John. There's definitely some gold in there, and if anyone on the call is looking for lecturers, I know there's a few of us in the banking space. From what I've heard today, both John and Ivan make pretty decent lecturers. We might attach their CVs to the presentations when we send them around a bit later. I'll pass now to Fiona to introduce our other panelists, joining both John and Ivan to host the Q&A session. Fiona is like a COVID baby in the banking team. Fiona joined our NAB education team at the start of the pandemic last year, but she's had over 10 years experience covering NAB's largest institutional clients. We're glad to have her on board. Over to you, Fee.
Thanks, Michael. As Michael mentioned, feel free to submit any questions via the Q&A function, and I'll help direct them to our panel members. In addition to Ivan and John, with us on the panel today, we also have Tabitha Chang and Melissa Kwok, NAB's Debt Capital Markets Specialists for the university sector, to answer any questions you may have in relation to current conditions and themes in debt capital markets. So while we're just waiting for the questions to start coming in, I might start with one in relation to the rise of green and social issuances in debt capital markets. Noting the leadership the university issuers have shown in this space, Tabitha or Melissa, are you able to share some insights or anecdotal feedback that might help our audience on the current supply-demand dynamics and whether you're starting to see a price differential occurring for ESG issuances?
Fiona, and hi to everyone who's joined the webinar. So I'd say from the DCM perspective, we've sort of seen an increase in sort of focus on the ESG sort of sector. And, you know, we've seen that across all the transactions that we sort of work on in the Aussie dollar market. Investors will always be, you know, asking questions about the green and sustainability element, regardless of whether or not that transaction is specifically marked. And, you know, we're also seeing investors, you know, have specific appetite for ESG sort of transactions because they may have specific funds where they can allocate specifically earmarked debt. And as you know, university credit is in nature sustainable and social, but because these investors have these specific mandates and need that debt to be, you know, specifically marked to go into certain funds, it's definitely become front of mind for them. And, you know, in response to that, we have seen a rise in sort of sustainability linked instruments in the market this year. And, you know, issuers are doing a lot on the sustainability front. So I think it's a strong way for them to sort of reflect back to the market all the different things that they might be working on. And in terms of pricing, it's hard to sort of pin down a specific number because there's so many things that drive transactions in the market, but we definitely see, you know, a stronger bid from investors for those linked transactions and a higher willingness to sort of follow the book down as the pricing is revised. So what, you know, with caveat is that if an investor is not traditionally looking to buy university paper, having it being sustainable or social linked might not necessarily get them to participate, but the existing investor base will definitely have deeper and stronger demand.
Thanks, Melissa. That's great. I might just throw one to John if I can. You touched on it a little bit before. It'd be great if you could share your thoughts on what the sector and government could do best to position for the changing political environment. Are you able to share with us Moody's views on the implied government support for Australian universities? And has it changed in any way as a result of COVID-related policy decisions?
Thanks, Fiona. It's actually been really interesting. There was initial talk about JobKeeper not being fully available for the sector. But I think on balance, when we look at Australia, that level of support from the Commonwealth and also the support from the states, there was quite a bit of activity from the states providing backup support. That played out pretty much exactly as we would have expected. So at the moment, within the Australian universities, we actually assign a high level of expectation of an extraordinary support should a university face a liquidity stress event. And that's really been quite a distinguishing feature. And under our new methodology, where we've got the focus on operating environment, the Australian sector actually scores pretty much the top mark. The only one above Australia will be Singapore, which is effectively run by the government. CapEx is funded by the government. It's a very different beast. But outside of that, I think at Australia, very, very strong. That said, this year we did actually change some of our assessment of extraordinary support for some offshore names. You may recall at the start of February this year, Laurentian in Ontario filed for creditor protection. Now, we don't rate Laurentian, but the province of Ontario actually had indicated that it was in discussions with Laurentian to get possible support prior to providing creditor protection or filing for creditor protection. Now, during the process, Laurentian it went through the courts and it was directed not to make principal and interest payments to any creditors. Why did that matter to us? Well, I think for our side, we expected that extraordinary support, there was an underlying assumptions, but the universities wouldn't be able to file for creditor protection. And in Canada, under some provinces, that no longer holds true. So we did need to recognise that in our support. Overall, it was the implicit approval of the province to allow the university to proceed, or put another way, the inability of Laurentian to be prevented from filing for creditor protection, that really had a significant impact on the reputational risk to the sector. So we did lower some of our universities rated within the Ontario province, and that played through to the implicit support functions that we have. One thing that is some of them, it didn't actually affect the rating, but it certainly was a key observation from our perspective to say that what's been assumed in the past shouldn't be relied on to hold true. It's when the chips are down that policy responds. And what we saw in Australia was quite positive. Even the extra research grant funding that came through late calendar 2020, or was announced late calendar 2020 for this year, very much a positive. We have a neutral view on it not being extended into 2022. That really does reflect that the underlying credit profile of the sector, its resilience to the pandemic, the revenue shock that the pandemic proved to be, has been quite robust.
Can I ask a follow-up to that, John? Just, it's sort of related. Like, this has got to, I would have thought, be a bigger shock than you ever imagined for the university sector in a normal recession or Chinese slowdown or something like that. Has that changed your picture of, really how resilient the businesses are, given they were able, I think some of your points were they were able to cut out labour costs more than you expected, government support was forthcoming. How do you think about that from a longer term perspective?
Yeah, it's a good question, Ivan. I think the key is the quality of management, and that's not consistent everywhere, but before the pandemic, Blind Freddie could see there's a significant increase in the international cohort and the over-reliance of some universities on the Chinese international student. So our scenario analysis always included, well, what happens if that drops 15% tomorrow? What happens if, because we do live in a world of heightened geopolitical tensions and risks, and we need to say that that is a genuine risk. So, we've been working with our rated universities to understand what levers do they have to pull. That's very important to understand. But even more important than having levers to pull is having management who are prepared to pull the lever. So it's not just having the flexibility, but it's having the willingness to actually respond. And I think that was one of the particular strengths that we saw in the Australian universities that we rate.
Thanks.
Thanks, John. Ivan, I've got one here for you. We've seen a fair amount of growth in demand from international student markets such as China and India over recent years. With what you're seeing in recovery of economies post-COVID, how do you think that will impact the demand from some of these emerging markets? And are you able to share your thoughts on where we might see the next surge in demand?
Yeah, because I sort of hinted, I think the most important, I think education's an interesting good in that it has long-term payoffs. So people generally think about it as to a certain extent, non-negotiable for their kids. It does have some impacts on how the economic cycle is in other countries. So I did mention that China is interesting because it is definitely having a form of slowdown now. The government is trying to slow housing and move against, property investors. And then we've got the geopolitics, which I think it seems like that may be a secondary effect. And what I have shared in last year's webinar, which I haven't had this year, is the population growth rates for university age students are beginning to slow in China. Where they still look very, very strong is in India. So I would see that India would be an important alternative market for Australian universities over the next 5 to 10 to 20 years. It's got a young population, it's growing pretty quickly. China's population is older, and begins to shrink in that important university age demographic. So I'd say India looks like a prospective, complementary market.
Great, thanks, Ivan. John, perhaps another one for you. Are you able to share whether you mentioned some of the universities are offering discounts of up to 50%. Is that consistent globally, or is that Australia-based universities that you were referring to?
Some of the costs are actually being discounted more than 50%. It's very much US-centric at the moment, particularly in the colleges. But yeah, we've seen very little in Australia as far as discounting. UQ was probably the first to move in late 2020. But I think one of the challenges is not just being pressured to change your revenue profile, as we saw with some of the Canadian universities, but actually pursuing aggressive growth through discounting can lead to very unpleasant outcomes over time. Because one of the keys for the sector is not necessarily being a bulk provider of education, but it gets down to the reputation. It gets down to the integrity of the education offering. And that is something that we think will continue to support the Australian sector as we see increasing pressures for students to move to other, substitution risk, move to other jurisdictions for their international study. One of the keys that we think will continue to make Australia attractive will be particularly the strong rankings of our universities down here, over and above the ability to come here and have a relatively benign COVID environment in which to have your education compared to some offshore markets.
Great, thank you. Michael, it looks like you're about to jump in there.
Well, I reckon we've got about a minute left, so I might just pause the questions there, Fee, and I'd like to take this opportunity to thank everyone for sharing this hour with us. Big thanks to both John and Ivan, to Mel and Tab and yourself, Fee, for hosting the panel session there. We will share these packs with you. We'll get an email out over the next little while. And if you've got any questions, please do reach out to your relationship team. We can do individual sessions as required in each of the states. We can help answer any of the other queries you might have. But thought a really terrific addition to bring the Moody's insights to complement the economic update today. So thanks again, John, for sharing your time with us today. And that brings us bang on to 12 o'clock. So thanks, everyone. Enjoy the rest of your day and look forward to seeing you soon. Bye for now.